Good morning. My name is Alessandra Stabilini. I am a board member at ecoDa, and I wish to welcome you, to give you a very warm welcome to the last webinar of the series of webinars that ecoDa has organized on corporate governance in times of crisis. Our webinar today will address a very important issue, which is, as you know, directors' dialogue with shareholders in times of crisis. We have a terrific panel of speakers to help us to address the issue, including Benoît van der Hove, Andrea Bischoff, José Luis del Valle, Mark Sims, and George Dallas. And I wish to welcome and to thank all our panelists for being here with us today. I am sure that we will have a very fruitful and very thrilling discussion. May I remind to all our attendees that they can ask questions to our panelists by using the Q&A icon, which you should find on your screen. So just post your question on the Q&A icon, and then we will have a Q&A session at the end of our discussion where panelists will be able to address and answer your questions. So this said, I would like to start right away. I have a first question for you, Benoît, to open our discussion. In times of crisis, shareholders might seek increased dialogue with companies, especially with listed companies. And this dialogue might also involve sensitive issues, such as the future perspective of the business, changes in strategic plans, and so on. So my question for you is, how can and should the board find the right balance between shareholder information and the treatment of sensitive or even privileged, but also non-privileged but sensitive information regarding the firm? Should issuers be forced or incentivized to disclose more than in usual times? And what if this impairs their market positioning, also considering that many issuers compete on the market with non-listed companies, which by definition are under lighter obligations regarding disclosure? So Benoît, the floor is yours.
Thank you, Alessandra, and thank you for having me on this webinar. I'm Benoît van den Hove. I'm head of listing at Euronext in Brussels. And the least that we can say is that, well, there was no real playbook available for this crisis. Who would have expected in January of this year all what happened since mid of March? Well, no one was really prepared for the situation, for the crisis, not the governments, not the citizens, and not the companies. And for the companies in particular, there was an infinite list of questions. Do we stay open? Do we close? Do we pay our employees? Or do we increase the salary for those who stay on board? What do we do? And basically, to all those questions, there were multiple stakeholders, and each of these stakeholders had its own view, its own perspective on the topic, on the issue. And when you have all these questions, all these uncertainties, all these different perspectives, well, that creates, of course, uncertainty, and that translated into an unprecedented volatility on the markets that we knew, that we saw, just because, well, no one was prepared, and our economic models, our economic system is not built to cope with this kind of crisis. And quickly, what happened? Because the impact was uncertain, the impact was imprevisible. Quickly, ESMA and the national regulators came with a specific request of transparency pursuant to the market abuse regulation. They basically asked that the impact of COVID-19 had to be disclosed as soon as possible by the companies if that information, if the impact of COVID-19 on the business of the company was likely to constitute inside information. And I think we can only support this initiative taken by the regulators, because that transparency is fundamental to the market. Without transparency, markets cannot function properly. And basically, the listed companies had no choice but to communicate. But what do you communicate? How do you do that? How would the board has role to challenge the management which is in place, to review the strategy, and that's what they did thoroughly. They met very regularly in the digital mode, and the crisis pushed the issuers to get in touch with their investors. What I hear from the issuers based in Brussels is that they had multiple contacts with the issuers in the second part of March, just to reassure them, just to tell them what they expect as being the likely impact of the crisis on the business. And for instance, also in Belgium, PwC issued an analysis of the BEL 20 companies, so that's the Belgian blue chip index, and 19 out of the 20 BEL 20 companies published the impact of COVID-19 during the quarterly results update. So we see that almost all the companies communicate. And what did they communicate? So they focused on strategy and what will be the next strategy? What's the impact of COVID on the strategy? Because there are lots of variables on the outcome of the crisis, and the inability or the lack of preparation in communication will lead to someone else doing the job, like an activist. And so it was important that the boards took it on, and that they took the ownership of this communication. And so the communication should also be two ways. You have to communicate to your stakeholders, but you have to also integrate the feedback that you get from your stakeholders. You have to understand what the investors are expecting from your company. And well, those who had that good interaction with their investors, well, they managed to keep up the trust of their investors, because markets, it's all about having the trust between an entrepreneur and investors, and that trust can only be built based on transparency.
Thank you very much, Benoît. You raised a number of very interesting issues, I think. And I see that José Luis wishes to react first. José Luis. You're muted, José Luis. We need you to unmute.
Exactly, perfect.
Oh, okay, that's good.
Thank you, Alessandra. No, I think Benoît is right. That's the right approach. We as companies should probably have send frequent updates to the market, so that the markets know exactly where we stand, what the impact is on our operations and our strategic plans. But the question is, do markets know that we don't have a crystal ball? We know probably better or more about our own companies than they do, and therefore we should give them our input. But do they know, do they realize that we do not have a crystal ball about what's going to happen with our operations, with the markets in general? Because when we started doing that, we looked at all the economic forecasts from many different firms, and they were all over the place. And we tried to come up with an average of what the economy was going to be, or how it was going to be performing, and then based our own input, our projections of operations, our projections of strategy on those forecasts. But unfortunately, we do not have a crystal ball, and I hope that the markets and the investors realize that that's the case. We know more than them probably, but we don't have a crystal ball either.
Thank you, Jose Luis. I think this is very true. And I also ask myself whether it makes sense to communicate sometimes that you still don't have a strategy, which is a very difficult thing to say, though, to the market, because you don't know what the reaction can be. I think Benoît has raised his hand. Benoît?
Yeah, indeed. The investors know that you don't have a crystal ball. No one has, basically. But on the other hand, showing ownership, showing that you're on the topic, that you are having different scenarios, that you're working on redefining the strategy, redefining the perspective for the year to come. That also shows that the board is strong. And I think also that in the case at hand, it might be useful to send to the investors not only the CEO but the chairman with the CEO, just to show that both of them are fully aligned on what has to come, even if you, as many of us, you still have a lot of uncertainties. But at least you show the strengths of the team, because basically it's the strengths of the team that will also help the company to recoup in these difficult times. So I would strongly encourage to be as transparent as possible on what you do and showing the strengths of the team.
Yes, Benoît, and maybe issuers should learn that one important thing to communicate to the market from now on is we are flexible and we can face uncertainty. So other than communicating a strategy on the merits, issuers should be able to convince investors that they are able to adapt, which is one of the most difficult things to do, right? Because once the pandemic curve flattens, and it has started to flatten in some countries or in many countries, then what's next? But we will see more of that with our last question of today. Is there any other panelist who wishes to react? Otherwise, we can move to our next question. Okay. So my next question, Andrea, is for you, and rightly so, since you are the managing director of Morrow Sodali, who everybody knows. One of the things that have happened during this pandemic is that in many jurisdictions, special provisions have been enacted restricting or even erasing the right of shareholders of listed companies to physically participate in annual meetings due to public health reasons. So de facto, we have seen shareholders meetings in this season taking place without a single shareholder being in the room, in the physical room, but even in the virtual room in some jurisdictions. So my question for you is this something that should be immediately abandoned after the pandemic ends, after the emergency ends, or has this crisis accelerated an efficient change and somehow unveiled the shareholder participation myth?
Thank you, Alessandra, and also thank you for having us here today. I think you are asking the right person, because shareholder participation in Germany, which is one of my key markets, is certainly very special compared to other markets. It's not a rare occasion that you have thousands, sometimes even 100,000 participants at an annual general meeting that will last for many, many hours and gives investors, private mainly, but also institutional investors, mainly local investors, the opportunity to have at the annual general meeting a direct dialogue with the board and of course also with the management. And so I think it is certainly the case that some issuers may wish to continue with the virtual only AGM. It saves costs, it is pretty convenient, but going forward, I don't think that is the right path, because as soon as health and safety allows for shareholders to physically participate again. That's an important shareholder right that will and has to be continued. Interesting also, participation levels at virtual AGM in general terms have remained pretty stable. The markets where we've done the analysis, we even seen AGM with higher participation for a virtual meeting than for an ordinary AGM with physical participation. And in particular in Germany and in Switzerland, as I said, participation remained very stable, if not even higher than under normal circumstances. And in other markets, we've seen smaller AGMs, or where normally the AGMs are smaller and don't have thousands of people being present. Institutional investors and proxy advisors have made very clear that virtual only is not the way forward. I think an interesting example is the Standard Life AGM. Standard Life, as you may know, they proposed an article amendment to allow going forward virtual only AGMs, and the rejection of this item, I think, is a clear sign of what the market feels. And I think the future, as I said, as soon as the circumstances allow again, will remain with physical AGMs. On the other hand, I think it has certainly accelerated technical developments, as well as legal discussions around providing online access to AGMs. What is called a virtual meeting and to what degree shareholder rights are preserved can raise substantially between markets and companies. And maybe these developments can establish a more balanced shareholder representation at AGMs across markets, such as nowadays in Germany, for example, it's private shareholders and German institutional investors being present. But if in the future, let's say a hybrid AGM is conducted and international shareholders wanted to participate, I think the technology has been developed now and actually, proven that it works to enable this going forward. But it will be a hybrid rather than a virtual only AGM.
Thank you, Andrea. So I'm very interested in what you're saying. So physical participation, or at least live participation to shareholders meeting, has still sense in the meetings of listed companies, and the possibility to ask questions and receive answers is still something valuable that we should preserve and we should return to as soon as we can. I see George wants to react. So George, please.
Thank you. And I just, I'll speak a bit more on this later, but I would agree with what ICGN, as you may know, is an investor-led body. And I think that she nailed it, really. I think that we're all having to face short-term compromises. And one of the short-term compromises is, in some cases, delayed reporting, in some cases, virtual AGMs. And I think we're trying to be pragmatic, but also, if we don't want to loosen standards for the long term that we don't think should be loosened. And I think that there is a benefit for having a physical presence, if nothing else, for retail shareholders, as well as for institutional shareholders who often have contact through companies through other channels. So this is important for institutional retail shareholders. But I think the idea, let's maintain some degree of physical meeting going forward, as Andrea suggests. But I think the virtual opportunity, this is the positive, I think, and it can, if you're a fund manager in San Francisco, you can probably participate in 3 or 4 board meetings, AGMs, in a single day, in a way that was, unprecedented before. So I think as long as there's a balance of rules in a way that shareholder rights are not compromised, I think that hopefully we can look at this as a lot of things almost in a win-win context. But I think that shareholders would not want to revert to a virtual only scenario going forward. I think that would be retrograde, but I don't sense that that's going to happen.
Thank you, George. Very interesting. Benoît, I think you're next, raised your hand.
Yeah, very quickly. In Belgium, as in many countries, you had different possibilities, and some issuers decided to hold the general meeting behind closed doors, with proxies gotten from the investors, and all questions had to be raised in advance. Well, this is maybe not the most appropriate way to have a general meeting, because the general meeting is especially the moment where you have that interaction between the investors, the shareholders, and the management, the board. And so I would strongly recommend to have at least a webcasting where people can also ask questions live, because so you stay as close as possible to what is a physical meeting, where you have that live interaction between the management and the shareholders.
Thank you, Benoît. Mark? Mark, did you raise your hand?
Yep. Can you hear me? Yeah, I think just following on from what Andrea was saying is that, you know, if you look at what's happened in the States with hybrid meetings, people moving more and more towards them anyway. You know, before the sort of COVID situation in the last quarter, last year, I think there was about 90 hybrid meetings. I believe that there was just over 1,000 before May this year, by the end of May this year. And I don't think they're all been related to COVID. So I think more and more companies are looking at these hybrids because it increases the participation and the ability, as George said, for more and more people to attend more of these meetings as they're in sort of condensed time periods.
Thank you, Mark. No, Jose Luis, did you want to react as well?
I thank you, Alessandra. I basically agree with what Benoît and Mark just said. There are virtual meetings and virtual meetings. If in those virtual meetings, you can make proposals, ask questions, that is very close to being there with the physical presence. And I think that's a way that would increase participation of certain shareholders, as Mark said. Then I'm very much in favor of that hybrid approach, in which you give investors who are not physically present the possibility, the opportunity of making proposals and also asking questions, not just voting, going further, going into proposals and also questions. That way, I think the hybrid meetings will be a way to go in the future in many cases.
Thank you very much, Jose Luis. So I think we can turn to our next question, which, by the way, is for you, Jose Luis. Given your experience as a director, an independent board member, and chairman of listed companies, in times of crisis, conflicts of interest among the different types of shareholders, like institutional versus retail or active versus passive, and conflicts among shareholders and other stakeholders of the firm can also be exacerbated. So my question for you is, how can the board deal with the different interests involved and the related conflicts? Clearly, this is a question for the board anytime, not only during the times of crisis, but in times of crisis, this can be particularly difficult for the board to do. And one question that I would like to ask you particularly is somehow procedural. How should the board deal with this issue? Should the board favor the immersion of conflicts, or should the board use its discretionary power to make a balance within itself, so to speak?
Thank you again, Alessandra. As you said, the conflicts that you mentioned have always been there. The difference now is that some of them are becoming more visible. As policies that were previously taken for granted do not necessarily apply in the current environment. For example, if the board takes a decision to cut dividends in order to preserve liquidity, some investors might see it as positive, as they never care that much about the income anyway, while others might be negatively affected as they were counting on that. They were counting on that income. As a board, I feel that we should avoid differentiating by shareholder type in terms of our engagement and level of commitment to them. Majority or minority, passive or active, they're all shareholders and must be treated as such. We should procure an effective involvement of all shareholders, proactively seeking a two-way interaction with all of them. While as the result of that interaction, boards should show sensitivity to shareholders' concerns, regardless of their weighting in the share capital, it is our responsibility as a board to lead the company, making whatever decisions may be necessary to achieve profits and sustainability for the company over time. Thus, in my opinion, we should exercise leadership rather than mediation. Facing diverse options among shareholders and with other stakeholders, the board must remain a consistent point of reference for the company's strategy in search of our corporate mission. That is what I think our shareholders need and they demand from us.
Thank you, Jose Luis. Before turning to our other panelists to hear their reaction, and I invite them to raise their hand to do that, we have a question from the audience, Jose Luis. The question is, what about, it comes from Paola Schwitzer from Italy, what about continuous communication to the market through press releases? So should this increase in this period? And should the board take responsibility for that? And should this communication become more focused on outlook and future expected performances? So might this be a way to deal with this need for dialogue, but also for balancing among different interests?
In my view, Alessandra, there is a temptation to flood the market with meaningless press releases and meaningless information. I think we should have a constant flow of information, frequent contact with our shareholders and other stakeholders, but saying something meaningful every time, not just issuing press releases full of information that really nobody cares about it, and we do it just for being there. I think we should really assess the situation, assess our views about the performance in the short term, medium term, our strategic changes that we need to implement, and then once we have the answers to that, go to the market. Maybe announce that we are going to hold a strategy day in 3 months' time, 5 months' time, whenever we have more visibility about the different issues. But in my view, at least, we should not be overflowing the market with meaningless information.
Okay, so keep the dialogue open, but do not communicate whatever if you don't have anything meaningful to communicate to the market and to your investors. What the other panelists think about this? Do we have any reaction?
Yeah, I'd like to react on what Jose Luis just mentioned. Indeed, you have to avoid meaningless press releases. I think that's creating a lot of smoke, which is useless. But in the times that we knew and that we are getting to know these days with COVID, you have to communicate more on the strategic options, on the strategic evolutions of what's going on, and yeah, that would require that you are more active on the communication side, but that communication will increase the trust in the company, will increase the trust in the management, in the board, and that's really crucial for the future of the company.
George? You're muted, George. You have to unmute.
Sorry, just to get to Jose Luis's point, initially, investors do not have a crystal ball, nor do they think that you do. And if they do so, they're probably deluded. But I think the point is that we would expect boards of directors to default, to what is your fiduciary responsibility isn't to any one particular investor. It's to the success and the long-term sustainability and value creation capability of the company as a whole. And I think a long-term investor should appreciate that. And I think one of the concerns that we need to think about in our profession is not trying to pressure companies to undertake initiatives that might benefit the short term, which could be a dividend that wasn't worth paying, or too much of a dividend. I think we need to temper anything with regard to the future. And I would agree that there's going to be sell-side analysts out there or others who need to have spreadsheets and models that they need to update. And I think that that's probably going to be a pressure on you. I think the key is to take those with a grain of salt. And again, if there's no substance to report, I think we need, I think this is such an evolving space. I think we all need to accept that we have to be, to some extent, comfortable with ambiguity.
Andrea.
Yeah, I think George just made the points. Based on what we've seen, I think, and I've been on the road with, a couple of Germans literally the moment COVID started and just before the lockdown. I think at those times, and that's something I think important to consider, it was all about, risk management, all about, how you assess the situation, what measures do you have in place, how you view this. No crystal balls expected. I think it was more, presenting you are aware of the issues and make sure you communicate that you're actually considering it. And now, while we are, for a longer time having been in a crisis, the topics that are being discussed getting into much more detail. Investors want to know, how do you address this going forward in compensation, for example? And we've seen, companies responding to this. I think, again, it's nothing that you should put into a press release. If the board decides the management is going to get 10% less pay during this year or going forward, it's something I think it's important for companies to consider, to discuss in a dialogue with their shareholders, but nothing to be put in a press release and to make a marketing initiative out of it, because therefore the times I think are too serious. And then of course, other topics such as, distribution policy, whether it's dividend or also capital increases. We've seen far more leniency this year, in particular for companies that are in sectors most affected by the crisis, that shareholders have given them more room for, let's say, a higher capital increase than they would do under normal circumstances. So these topics, I think, are topics that the board needs to show they are considered, but it's not necessarily something that we put in a press release. It's investor communication.
Mm-hmm. Thank you very much, Andrea. Any other reaction from the panelists? No? So I will turn to you, Mark, with a rather specific question that addresses, I think, a very important issue. In times of crisis, and we have seen this in other crises in the past, companies might seek an increased recourse to debt by issuing corporate bonds, at which point the relative position of debt holders vis-a-vis shareholders might change accordingly and might force the board of the issuer to adapt. Once again, this is not new. This does not only happen in times of crisis. Clearly, there are conflicts or potential conflicts between equity and debt holders in normal times as well. But clearly, in a situation of crisis, and especially if the crisis turn to a crisis for the firm specifically, these conflicts might increase and become a very big challenge for the board, especially regarding critical decisions like the ones that Andrea has just mentioned, like capital allocation decisions and dividend distributions. So is this happening within the current pandemic? What are investors' expectations regarding this issue? and how can the board react?
Great, thank you. I think to actually answer the question, I think it's first necessarily to put it into context of what changes have been happening in both the share and debt ownership over the past 3 months. It goes without saying that lots of companies have been negatively impacted by the pandemic, but also some companies haven't. It's actually been the reverse. So a lot of companies have been using this time, obviously, to raise money for defensive purposes, but some have been raising money for offensive purposes too. That is the same for investors. So there are a lot of investors have been using this opportunity to raise money cheaply and have been looking at the sort of low valuations and cheap assets as a time to position themselves for when the sort of COVID recovery starts. Since the initial sell-off, there's obviously been huge volumes in both equities and debt, with both sort of coming back to near positions they were earlier in the year. And the significance for issuers is that their communications to the shareholders and debt holders may be to different shareholders and debt holders as new people have moved into the stock and the debt. I mean, we've seen a re-emergence of funds that operate around distressed debt situations that have been sort of quiet or semi-dormant for years. Been raising money, raising war chests, and flooding into the cheap assets, and especially into the sort of debt market. And, despite rumors to the contrary, the activists and more opportunistic hedge funds have not gone dormant. They've just moved to behind the scenes activity, which has been sort of evidenced by, increasing amounts that have been moved into prime brokerage and into both lending of stock and debt. And this can have a serious impact on the company and its sort of communication strategy and how they move forward. But it will depend on which side of the equation they fell. Are they in the sort of looking at in sort of money from a defensive position or offensive? So, in the immediate early stages, it was obviously about liquidity, actually getting liquidity back for the companies as cash flow dried up. But that led to a lot of issues having to go to tap the debt markets at sort of very high interest rates, which meant that the investors obviously saw that as an opportunity to sort of flood in and take advantage of that. In fact, you saw about 250 billion flow back into the debt market over the quarter, which sort of put record highs. In fact, over 6 days between June the 4th and 10th, there was about 25 billion flooded into debt alone. And this can have sort of a big impact actually on the sort of ownership structure as a result. So as the companies have now moved out the immediate liquidity issues, they're looking more to the sort of longer, medium-term sort of recovery phase. Investors are now looking to how those companies will raise money and how they'll manage that capital allocation, with the backdrop that obviously a lot of companies have far more leverage now and still little certainty of when cash will flow back to normal levels. So this will have an impact on how the investors actually determine risk, and looking at how the management of the companies will be looking to mitigate that risk for those investors. So what are the investors' expectations? Well, that will very much depend on the motives that you've gone to the market to raise money. So if it's defensive, obviously the equity investors, if you've gone to the debt markets, will want to know how much debt you have raised and on what terms, and how is that capital allocated and how is it being funded. So it will depend really also on the types of investors too. So, how will that impact retail and pension funds? It will depend on the sort of investors you've got there. So if the situation is you're going to the market to do this, then both the shareholders and debt holders need to know what is the institution's sort of instruments they're doing. The company doing. So if the company is going to the equity market and the debt market simultaneously, so putting out interconditional transactions, that has cooperation of both the shareholders and the debt holders. If it's sequential, it'll depend on whether the company's gone to the equity markets to raise money first or the debt market, but both will impact each other. So, that you've got to bear in mind from an investor's point of view, how that'll impact them. So, moving on then from the company's point of view, they need to then see how those investors will sort of perceive how they're dealing with the situation and what their sort of perceptions of the company's board. So for an issuer, the board needs to be now ready to engage with shareholders and bondholders as they may be one and the same. I think it's fair to say that a lot of institutions that both buy into equity and debt, they don't necessarily regularly talk within the institutions, but that has been changing. You know, corporate governance and the obligations under the stewardship codes, which now include debt, have meant that the institutions do take a very different look at issuers. And it's sort of turning to more of a holistic view and looking at the sort of exposure and the risk cross asset, which is why I think, you know, a lot of companies are increasingly finding bondholders turning up to non-deal roadshows because the institution's looking at overall exposure for them. So that has meant there's been more coordination within the institutions, and you know, they increasingly want to know what the specific questions they have for different parts of the issuer. So where you've got the equity investor still talking very much to, you know, the CFO, the CEO, head of IR, you've also got bondholders that may also want to join the meetings but engage with treasurers, corporate finance, whoever's responsible for the debt. What you're also seeing is increasingly that companies are needing to sort of proactively reach out and engage with them to understand what they want, who they want to engage with, and when, to make sure that you know, they're actually meeting the requirements of both sets of investors. So I think, you know, the only way really for companies to deal with this is to reach out, is actually to engage and realize that they may be engaging with a different audience. The ownership structures might have changed significantly over the past 3 months. So they might not be the same shareholders and debt holders they were talking to in January, and they may have different requirements. And the onus, I think, is very much on the company to understand that and prepare for sort of new sets of questions as the sort of COVID recovery phase starts.
Thank you, Mark. Again, very, very interesting, your point. I think you raised a number of issues. And while waiting for other panelists to raise their hand, there are a couple of very challenging points, I think, that you raised. Well, more than a couple, but two that come immediately to me. One is, along with equity and debt holders, then you have the other creditors of the firm. Many firms are exposed with banks outside capital markets, and these creditors are completely different from bondholders. Because the market for this debt is completely different, their expectations are completely different, and they're used to talking with companies through completely different channels. So this is another challenge on top, I think, which also relates to another very important point that I think you mentioned, which is people within the company that who usually talk to different stakeholders are different. So you don't typically have the same people talking with shareholders than the people within the company talking to debt holders. So this poses a very serious question of consistency of communication within the company, and maybe also of education of people within the company. In many non-major listed companies, there is only one investor relator who's skilled enough to talk with stakeholders, but other people within the firm, like the CFO, for example, might be forced to engage with a dialogue, and not necessarily he or she is able to do that. So a number of issues rise.
Yeah, sorry, Alessandra. Yeah, and I think, you know, it does depend from an issuer's point of view. If you are, you know, raising shares, or if you're actually sort of looking at the market now to, you know, increase your debt position or sort of change your existing debt arrangements, sort of changing, you know, term agreements, you know, covenants, etc. That will have an impact on the shareholders. If you're issuing more debt, then again, that will impact the shareholders and their view of the sort of strength of the balance sheet. If you're going to the equity markets, like, you know, for instance, Compass, who raised money, you know, a couple of weeks ago, how's that money going to be used? If it's going to be used as they were doing to sort of deleverage their debt or pay down the debt, that can strengthen the position for all. And if you're an institution that's holding both the equity and the debt, it's vital that you're looking at this from an overall risk perspective. And the institutions have become much more coordinated internally because of the corporate governance and the aspect of how they look at the company more holistically, which will only increase now that debt is sort of included into the stewardship codes. They will start being more accountable to their investors. They will start wanting to look at the company and understand risk and look at other things that investors want to talk about in regards to sustainability and corporate governance standards. So they will more and more include themselves in the meeting. So the issuers have to be prepared to field people that might have a different set of questions, but around the same themes, the same subject. So, it will be increasingly important for the companies to be more coordinated internally. What you don't want is obviously different stories being told to different types of investors, and it's got to be sort of consistent and joined up. Otherwise, if it's not, then the investors will perceive that as a sort of a sign of risk if it isn't joined up. So the onus is on the companies to get prepared for this, and it will change as we come out of recovery, as companies will be going both to the debt and equity markets.
Thank you, Mark. George just raised a very important issue, which is, he wrote to all of you, what I learned in my credit training when I was at Wells Fargo, is that the creditor is the ultimate bearer of the residual risk. So creditors can become shareholders even if they don't want to. That is very true. And it's so true that corporate law basically says that directors' fiduciary duty shift to creditors once the firm is failing or likely to fail. George.
Yeah, I think the role of the creditor in corporate governance is really underexplored. And I think we're going to be developing this further, particularly as stewardship codes increasingly, or as Mark said, embracing not just listed equities as an asset class, but a broad range of asset classes, of which corporate debt will be very prominent. I spent a lot of time thinking about this in my experience prior, when I was at Standard & Poor's, looking at bond ratings and that sort of thing. And I think we need to accept that both debt and equity are a reality for corporate funding in the long term. Debt issues come and go, but it's always part of the permanent capital, as is equity. And I think if you take a long-term perspective, and many institutions, as Mark said, hold both debt and equity positions and are beginning to bring this together, we need to think in terms of a sort of an enlightened shareholder, which needs to recognize the importance of having a loyal creditor base that can provide the company with money, easy access to money at a good rate. And also the enlightened creditor needs to understand that a company is also under obligations to its shareholders to do what it can to provide returns on equity that ultimately feed into their beneficiaries. I think if we take a long-term perspective, to use Mark's term, focus on the firm in a holistic way, I think some of these conflicts can be avoided, although in the short term, if a company is facing immediate bankruptcy or insolvency, obviously the interests of creditors and shareholders is inevitably going to separate.
This is very interesting. I will take the challenge, George, because how do you make a shareholder an enlightened shareholder, and how do you make a debt holder an enlightened debt holder? Because this is not easy. So who should do that?
Well, I think that's part of the steward. You're right. It's because oftentimes it's not in every asset management house, but you have silos. You have the equity silo, you have the debt silo, and as Mark said, sometimes they don't talk to each other, sometimes they do. I think as the pressure is building, and well, not for pressure, but as the momentum is building for thinking about stewardship in a broader context, I think it will force both creditors and shareholders to recognize, which I hope is a fairly obvious point, that they need one another. It's almost a symbiotic relationship in the long term. And, I think both need to protect their own interests, but I think that there's a lot of overlap in terms of both wanting to promote a company that is governed well, which has a sustainable business model, that manages its ESG risks appropriately. There's a lot of common ground. And I think building that common ground is perhaps an important first step.
Yeah, and I would add, I agree with you, George, and I would add that the board plays a critical role in this area, a very critical role. So it's very important for the board to be prepared somehow to favor this movement that we are starting to see, and maybe the crisis has helped a little bit, at least in this.
I think just to add,
if there is, yeah, go ahead.
Yeah, no, just saying. To add to what George was saying, it depends how the companies actually sort of plan to stabilize and actually look at the long term company. So if they are going to the debt markets, how is that going to impact the shareholders? If you're increasing the debt, putting more out there, will that mean that your sort of the balance will change and certain shareholders you'll fall outside their investment parameters, so they'll become forced sellers. So they've always got to be mindful of the impact on both sides, especially given that you can have shareholders and debt holders from the same institution. So that sort of puts a communication challenge there that really needs to understand what the drivers are for those investors in the first place to be there.
Thank you very much, Mark. Before moving to our last question, I wish to remind our audience once again and to invite them to ask questions to our panelists that we will address for them. So let's move to our last question. My victim in this case is you, George, but it's really a question for everybody, and it's a very typical meaning of life question. So I'm sorry about that. And the question is the following. Many people seem to think that the COVID-19 pandemic will change certain things forever, or at least for a long time. Is this true also in corporate governance?
Right.
Are there lessons learned in corporate governance that we should keep in mind for the future? And to ESG and sustainability, is this going to fade away as a result of the pandemic? Or is sustainability the way to cope with a potentially multi-pandemic world?
Well, Alessandra, those are big questions, and I'm pleased to be your victim. I'll take a stab at this. For those of you, just as background, who don't know ICGN, we're an investor-led body, membership in 45 countries globally. Our investor members total $54 trillion of assets, so we have some of the major players. And what we try to promote is good corporate governance in companies that investors invest in, but also turning the spotlight on ourselves. We're also emphasizing responsible investment practices, stewardship, and being a part of the solution and possibly not part of the problem. I would also point out that of that 54 trillion, which is the capital that our membership represents, we don't have a precise statistic, but I would guess that anywhere between 2/3 and 3/4 would be pension money, where the liability horizon is certainly long-term, if not theoretically infinite. And I think that it's an easy thing to say. Maybe it's difficult to reduce to day-to-day behaviors, but I think having that perspective is critical, and it has to drive our thinking, particularly in this time. Will things change? Yes, I think this is a point of inflection. I think we're going to be seeing new business rules, new business. Our own company is one which has had traditionally a substantial part of its revenue base on conferences, physical conferences. We're having to think a new business model for our own humble operations, and I think this is typical of what many companies around the world are having to do. I think that there's opportunities that are presented here, and I think we need to seize on that. We talked about, I think there seems to be general consensus around this group that, for example, hybrid AGMs, if it has the right ground rules, can actually be a positive step forward. So, I think we need to embrace many things, but I think we should not embrace changes that take us a step back. And I think what will not change, hopefully, are core values that I think hopefully companies regulators, exchanges, investors will all embrace, which would be the OECD principles of fairness, responsibility, accountability, and transparency. And I think we need to look at potential changes through this lens. Changes that complement this, I think, should be embraced. Changes that don't, I think we should challenge. And this is a period of time in which, you know, investors have compromised a bit. You will see many investors agreeing with the point that in many cases, not all cases, but in many cases, it's only a responsible thing to do for cutting dividends for certain companies in certain sectors. But on the other hand, what we don't want to see is when we're also, you know, been open to seeing, we have to accept the fact that in some cases corporate reporting has been delayed, or in some cases virtual only meetings have taken place with some successes and some not successes. And you know, I think the challenge is to say, how can we survive this, but also assess what sticks, which will be good with regard to promoting hopefully corporate sustainability as well as shareholder rights, and perhaps rejecting some of the changes, some of the accommodations that we're currently living through right now, which we don't want to see maintained. So I can get more specific, but we've done various commentaries on AGMs, corporate reporting. Capital allocation is a huge issue. It raises all sorts of questions, which we can maybe get to in a minute. Executive pay is something I think companies need to think about themselves in terms of ensuring that their own executives are sharing the pain along with their workforce when that's required. But I think our main emphasis is to try to demonstrate solidarity with companies to survive the immediate term, and to focus first and foremost on the fact that we're dealing with a humanitarian situation, and that has to take precedence. But to your question about ESG, this is potentially an inflection point for ESG as well, and I guess it potentially could go in two directions. Some people may want to say that we have too much else to worry about than to focus on, you know, what may be a luxury in terms of ESG factors. I think and hope that group would be in the minority rather than the majority. If nothing else, I think this COVID crisis is showing the S of ESG and what teeth that has. I think there's been such a huge focus on climate leading up to this that we're starting to see that other issues are important as well. And at least in our own investor language, we're using the term systemic risk to think about whether it's a pandemic, whether it's climate, whether it's human rights, or even broader issues such as corruption. And I think if you take the premise that investors, at least many of them endemically have a long-term perspective, I think if anything, I think my hope is that we embrace the knowledge of how a society can come together and attack something like the COVID virus, and seeing how this can be perhaps a model with which we can mobilize as, you know, as market participants, as a society, to address other broad systemic issues, which could even have a bigger bite in the future. So my cautiously hopeful conclusion, Alessandra, is I do think ESG is here to stay. And I suspect, if anything, it might be reinforced by what we're currently going through.
I'm personally very happy to hear this, George, especially from you. And Andrea.
No, George, I think it's fully right. And the ENS, I think, in those months now has really, let's say, grown up to the G. I mean, the governance topics was for many years the key topic of the engagement, but the ENS, and most interestingly, it's not just, let's say, the investors who always cared about governance that, you know, raised the ENS topics such as human capital management or supply chain is, well, it's one topic, but nevertheless, it's a topic that is discussed more often. But what we're seeing, and what is very important, that it's not just those governance sensitive investors or ESG sensitive investors who care about those topics, but also very active managers who may not have had a strong ESG focus in the past, certainly realize that in times of crisis, those topics really matter. And in particular, the human capital management topic is a topic discussed widely by all sorts of institutional shareholders and no longer only by, let's say, special ESG-driven funds.
Thank you, Andrea. Benoît?
Yeah, I'd like to focus on one specific topic because George and Andrea already covered a wide range of topics, but it's the way issuers will interact in the future with their shareholders. For an IPO, you know the roadshows that have to take place prior to the listing, and once a company is listed, well, it goes on a regular basis to meet its investors, and that requires a lot of availability of the management, a lot of availability of the investors. And you travel around the world meeting investors. You spend a lot of time in the airplanes, in the taxis, on the trains, and that time was not well spent, was not very efficiently spent. And what we noticed during this crisis is that well, each of us we had the opportunity to spend our time very efficiently because we were just moving from one meeting to another one just through a click. And that's what's happened also on the roadshows that took place since mid of March, where basically the number of interactions with investors drastically increased, but the time spent on it was much lower than what it used to be. And I hear many issuers telling me, well, in the future, I'm not going to take the plane just to go to the US to meet two investors. Next time, I'll do it via Zoom, via WebEx or Teams. And if you look at Pexip, for instance, which is a company which was listed in the months of May, they saved 1,700 hours of management time and 8,200 tons of CO2 just by doing their roadshow in a virtual mode. So that way of interacting will also question the future way the companies will interact with their investors, and that will probably also come in the ESG policy of the company going forward.
Thank you, Benoît. José Luis, then we have a question from the audience. José Luis?
Yes, thank you, Alessandra. I just wanted to reinforce George's messages, in particular related to COVID-19, because it caught us, most of us, I won't say all of us, but most of us, it caught all of us by surprise. And now we need to realize that the systemic risk does exist. And therefore, we better take care of the S in ESG. I think George was right on that. And we better be prepared the next time one of these systemic risks really materializes.
Thank you, José Luis. I very much agree with you. I have a question from the audience for George especially, and then I have a question myself for all of you. So the question to you, George, is what do you think company boards can do to better address the overlaps in equity and debt holders, e.g. in terms of meaningful common ground reporting? And conversely, what should creditors be doing more of? The question comes from Ms. Rachel Johnson.
Great.
George?
Thank you. Well, I actually took the liberty of posting a link in terms of a report that we released last year about the interrelationship between creditors and shareholders in corporate governance, making the point, particularly for investment grade companies that are clearly solvent and not an immediate threat. There's just as much, if not more, common ground than there may be separate ground between creditors and shareholders. And I think the issue, again, as I said earlier, is promoting good corporate governance and a sustainable capital structure. I think that there's going to be a tension between how a company manages itself in terms of its balance sheet and its use of capital. That has to be, again, my view is that there has to be a sustainable equilibrium for both a creditor and a shareholder. I think what creditors, to the specific question, and it's a good one, what should creditors do now that they're not already doing? And I think that equity holders should look for this as well. we should possibly have more articulate statements of capital allocation in terms of how a company is approaching its finance. What should a creditor expect the company to do to protect its credit quality on the one hand, and what can a shareholder expect in terms of a shareholder's need with regard to a service of its own beneficiaries to provide sustainable and fair returns on capital. Again, getting that balance right is important, and I think part of that is having a dialogue, which if nothing else might be stimulated by a bit more disclosure in this context than we possibly already see. And to Benoît, just to your quick point, we're dealing with the same existential question that you're asking. And our own view at ICGN, having hosted conferences in the past and asking what our own business model is going to be going forward, I don't think it's going to be 100%, 0%. I think human beings will continue to need to have and want to have some capability to have face-to-face interaction. But I suspect that's going to drop substantially given all what's going on, and given technology, this is the opportunity that's embraced. As long as it has good ground rules, as long as the types of meetings that you have online do not suffer or do not dilute their value relative to in the flesh, then how can you argue with it? But my suspicion and my hope is that there will still be a need and desire for people to meet, at least to some extent in the future going forward, but probably much less than is currently happening.
Thank you, George. I have a question for actually all the panelists, whoever wishes to answer, which is many of the things that that all of you have said today call into question the role of shareholders, especially regarding the purpose of the company and the strategies of the company towards this purpose. Why shareholders? Well, because after all, while we're talking about a multi-stakeholder company, we do have a corporate law almost everywhere that puts shareholders in a very special position regarding the company as opposed to any other stakeholder of the firm. And we cannot deny this. This is in the law. I mean, shareholders are basically the only one who appoint and remove directors to begin with. Even in Germany, this is true even in Germany. Well, because even where co-determination is strongest in Germany, at the end, if I'm not wrong, shareholders have the last word. So the role of shareholders comes into question. And I think this poses a number of difficult issues because how can companies make shareholders engage in defining the purpose of the company? We want shareholders to be long-term, but we cannot force them to be because they are what they are. So should the board push shareholders to speak other than engaging in dialogue with them? Should shareholders be put in the position to say what their expectations are and to take a side on the possible options that the company has for its future, on the length of the term, how long should the long term be, and things like that? It's another impossible question, so nobody wants to answer.
I can jump in. I think, what a lot of what you're saying there is being provisioned by how the stewardship codes are evolving. They are putting more onus on investors, whether they are shareholders or debt holders or both, to be much more responsible investors. They have a duty of care to their investors. So if they're managing money on behalf of pensioners or other people, they have a duty of care downstream as well. So it really is important, and the stewardship codes, I think, are getting this absolutely right in terms of, forcing those shareholders to monitor their investee companies, but also to work with the other shareholders. They are the collective owners of the company, so they have to act on sort of collective basis of responsibility there. And if they are talking through networks like ICGN, which they do, and I think everyone recognizes that, companies need to be aware of it. You know, one voice might be voicing the opinions of many, many shareholders, and the companies need to anticipate that and understand what they all want collectively. You know, obviously they're going to have different drivers. You know, what an income fund wants out of investment is going to be very different maybe for a, you know, from a hedge fund. But, you know, collectively it's the only responsibility of the company to provide an outreach, you know, communications and outreach to those investors so that they can meet their obligations under the stewardship codes, which are making them more responsible and more communicative.
Thank you, Mark. José Luis, did you raise your hand? Otherwise, Benoît?
Yeah.
Go ahead, Benoît, please.
Okay, thank you, José Luis. Yeah, quickly, the multiple stakeholder perspective is also more and more on the agenda of the companies with the non-financial reporting that they have to do. Also with all the focus on ESG, where investors expect the issuers to come with their impact on society as a whole. So indeed, the shareholders remain very important into the relationship with the company, but the society and the stakeholders as a whole are being integrated more and more into the relationship between the investor and the issuer, because also as rightly spotted by Mark, investors have also their own investors, which are also asking them to come up with sound investment policies.
Sure. José Luis. You're muted, José Luis.
Thank you.
Okay.
It is true that now we have a better idea, probably most companies, of the collective view of investors. And I think that's good. It's good to know. But at the same time, and as I said before, we need to have that two-way interaction with them. We should explain how we see the company, strategy, discuss it with them, but we also need to listen as companies. We need to listen to our shareholders in general and to other stakeholders, not just the collective view of them, but also the individual view of those stakeholders having this two-way interaction with them.
Thank you, José Luis. George, I think you raised your hand.
Yeah, thank you. I mean, it's a huge question, and it's good that it's being debated. I think the purpose of the company, it's had a renewed life. My own personal view, well, firstly, if we accept the premises I hope I made earlier, that investors are increasingly switching on to ESGs, just recognizing, if nothing else, it's economic, if not it's moral imperatives. This is part of the equation. If you accept that, then as Benoît said, thinking about stakeholders, you can't avoid that. So I think, and if I was a company manager or a company board, you can't isolate, you need to take all of these constituencies into consideration. I personally think it's a false dichotomy to think of stakeholder primacy versus shareholder primacy. I think that can pervert things and potentially it's very loaded. It's going to be hard for me to see a corporate form in which you don't have shareholders playing an important role as they do now in AGMs in terms of looking at capital resolutions, electing directors and that sort of thing. But I'd prefer to put forward a model of company primacy. And again, this reflects the fiduciary duty of the board of directors to promote the long-term health and success of the company itself. And I think if you do that appropriately, a board and the company needs to find a way to, again, balance and find a sustainable equilibrium between what are the necessary interests of shareholders, creditors, as well as customers, employees, communities, and the like. The world is getting more complicated. It's not getting easier. So it's not, I think, simply a shareholder primacy model is flawed. But on the other hand, I would commend to you a recent article by Lucian Bebchuk of Harvard Law School, who pokes holes I think some serious holes in the the argument for stakeholder capitalism, arguing in part that what does that mean and which stakeholders and who determines them, it can be a recipe for possibly an undisciplined form of governance and planning. So I think, again, I would emphasize that focusing on the company and its success and on a long-term basis, and one would hope that that should bring along with it the interests of investors as well as stakeholders.
Thank you very much, George. Thank you. Mark, did you want to step in?
Actually, George just covered it, but I would just, add to that. Maybe, it's important for issuers to understand there's no such thing as sort of passive investor when it comes to how they look and engage with the company and increasingly using their voice and their vote, because they're, as I say, they're getting pressure themselves from investors. You're even seeing sort of family offices, the generations are changing. So the people that were managing the family offices have started, to retire in. The new generations moving in are much more focused on sustainability and corporate governance issues. So companies just have to be a lot more aware of the types of shareholders they have and what's driving them. And as George said, it's to deal with all the stakeholders in the same way.
Thank you, Mark. I think we have come to the end of our discussion for today. And I hope that the discussion has been fruitful and interesting. It has been, certainly to me. And I wish to really, really thank you, all the panelists for that. That was interesting, challenging. I will go back home with a lot of things to think about. And I also must say, with a little bit of hope for the future, which is something very valuable to me, especially in these hard times. So thank you, really thank you very much, each of you, for being here with us. And of course, a very big thank to our audience, which has remained with us till the very end. So thank you very much. And hope to see you physically next time for a new and thrilling discussion. Thank you very much.
Bye-bye.